Imagine you're standing in the middle of this massive state-of-the-art railway control room,
All right, okay, I'm picturing it.
and on the left side of the room, you're watching this high-speed bullet train just accelerating flawlessly down the tracks. I mean, it is breaking every speed record known to man, engineered to absolute frictionless perfection.
Right.
But then you look at the right side of the room and there's a heavy freight train. It's loaded with hazardous materials, and the structural supports of the bridge ahead of it are, well, they're actively buckling under its immense weight.
Yeah, that's a terrifying visual.
It gets worse.
Yeah.
Because the detail that makes this scenario truly terrifying is that the engineers driving the bullet train and the engineers driving the freight train, they are completely ignoring each other's reality.
They're just operating in two entirely different worlds.
Exactly. So welcome back to the monthly deep dive into the ASWAC 4U Market Pulse. Today, our mission is to unpack the May 2026 issue. We are tearing through the data across, foreign exchange, cryptocurrency, equities, and macro policy.
Because we need to understand exactly how your quantitative models should actually trade a market that has, quite frankly, violently split into two completely different realities.
Yeah, and that control room analogy, it perfectly captures the exact systemic tension we saw this past May. But before we diagnose how to trade that massive fracture, we really need to talk about the tools we're bringing to the table.
Oh, absolutely. Navigating a decoupled environment like this requires precision machinery, which makes the product news at the top of this month's issue incredibly timely.
Right, the release everyone's been waiting for.
Exactly. The AnyTrader system, which has been in deep, deep development since last November, is finally released.
Wow, finally.
Yeah, it's out. And this is a fully cohesive MetaTrader 5 expert advisor. It links directly to your dashboard configurations and doesn't just alert you, right? It actually calculates the exact risk size lot based on your parameters and executes the trade.
That's huge. And the detail that really stands out to me in the release notes is that two major foundational tools from this ecosystem are now, well, they're entirely free in the member area.
Completely free.
You have the E&I Trend Web, which gives you the global verification matrix across 21 distinct assets and, 8 different time frames?
Yeah, 8 time frames.
And then you have the Beaux-Arts scanner, which is running 23 different analyzers. It's processing everything from Elliott wave structures down to raw institutional order flow.
It's a massive amount of analytical density.
Right. And look, building institutional grade machinery like that, it requires immense capital and time. So my question is, why give that away at zero cost? And why do it exactly right now in this specific market cycle?
Well, the decision really stems from a necessary shift toward radical transparency. I mean, if you examine the retail and even the semi-professional trading space over the last decade,
It's been a bit of a mess.
it's been built on a trap of blind faith.
Right.
You have an industry that routinely asks individuals to risk actual capital based on, cropped screenshots posted on social media.
Oh, the classic Twitter flex.
Exactly. Or they're selling these opaque, compiled black box indicators where the underlying math it can't be audited. So by putting E&I Trend and the Beaux-Arts scanner into the public domain at no cost, serious quants are finally handed the actual instruments to verify the market bias independently.
So you don't have to just trust whatever the prevailing narrative is on financial TV.
You don't. You look at a canvas of 23 analyzers, and you locate the mathematical confluence yourself. But, the scanner access is actually secondary to the most vital piece of this rollout.
Which is the NE Trader Lab.
The AnyTrader lab.
The lab going live on the website, it really feels like a fundamental shift in how trading systems are presented. Because for a systematic trader, marketing copy is just noise. It's completely meaningless.
Right.
The lab is where you actually prove the physics of the model.
That is the exact intention. The lab publicly features the K&A Quant Holdings Institutional Master Account track record. And this isn't just an Excel sheet. It's pulled directly from Interactive Brokers via their official API integration.
And it's benchmarked.
Crucially benchmarked. Daily. Against the S&P 500 and the Sonia hurdle.
Okay, for the modelers listening who might focus more on crypto or FX, let's define that. Sonia, the Sterling Overnight Index Average, that's the baseline risk-free rate.
Exactly. Because if a trading system can't clear the return you get simply by, holding overnight cash at institutional rates, it is structurally failing.
Why take the execution risk if you can't beat the risk-free rate?
Right. Now, we do mathematically obscure the nominal account balances just to protect privacy, but the percentage performance and the drawdown metrics, those are entirely public.
You're shipping the evidence right alongside the execution tools. And the evidence is comprehensive. I mean, the lab includes recommended strategy backtests spanning 7 years of tick data, plus that massive Elliott Wave research archive. I saw it's logging over 1.3 million individual setups across all those timeframes.
Because, look, a system is only as trustworthy as the historical data sitting next to it. In an environment as fragmented as May 2026, relying on a system without a verifiable historical baseline is, well, it's essentially gambling.
Yeah, and that fragmented environment is exactly what we need to dissect today. Let's return to that control room analogy. The May issue defines the absolute spine of everything that happened in the market as this two tapes thesis.
Two tapes, yes.
You have two massive prevailing trends running on entirely different clocks.
Well, to contextualize May, you really have to look at the sequence of events that started back in April. Because April was the regime test.
Just a warm-up.
Right. The market experienced shocks in both directions, sure, but the overall correlation structures held together. But then in May, it stopped being a stress test and became the permanent operating environment.
So what's tape one?
Tape one was the global bond market, and it structurally buckled under the compounded weight of inflation persistence and sovereign supply shocks. I mean, we watched the 30-year Treasury auction clear above 5%.
Wow.
The first time since the summer of 2007. What you witnessed was the term premium being aggressively rebuilt in the open market.
I want to pause on term premium for a second because it's one of those phrases that gets thrown around financial media without much mechanical explanation. For the quantitative models listening, term premium isn't just the yield, right?
No, it's not.
It's the specific extra compensation an investor demands to lock their money up for 30 years, rather than just buying one-month bills and rolling them over continuously.
That is a perfect mechanical definition. Term premium is literally the price of uncertainty. For the last decade, central bank quantitative easing effectively crushed the term premium down to zero, sometimes even negative levels.
Because the central banks were the price-insensitive buyers absorbing all the supply.
Exactly. They bought everything. But now they've stepped away. So the market is forcing sovereign treasuries to pay a massive premium to clear that long-dated debt. Buyers are terrified of where inflation and fiscal deficits will be a decade from now.
So that is tape one. That's your heavy freight train buckling the structural supports of the bridge.
Right. And while that slow motion crisis is playing out, you glance at the other monitor in your control room, and you see tape two.
The silicon supercycle.
The silicon supercycle. Tape two carried the entire technology and compute hardware sector, and it simply went vertical.
It melted up.
It melted up. And the leadership was entirely concentrated in this one specific theme. The really astonishing part of May was that the immense stress emanating from the bond market tape one simply could not reach the silicon tape.
The cost of capital was spiking globally, but artificial intelligence infrastructure stocks completely ignored it.
Ignored it completely. Therefore, the single most critical lesson of the month for any systematic desk was that your primary trade was not about picking a directional bias on the broader indices.
Right, because the index is just a blended average of the two takes.
Exactly. The trade was entirely about measuring the variance between these two tapes. Dispersion replaced the index as the primary unit of return.
So if your single-factor model was just keyed to, like, market beta, assuming a rising tide lifts all boats, you completely missed the reality of the month. You were actually long the AI infrastructure factor and heavily short the duration and legal overhang factors, probably without even realizing it.
And bleeding alpha because of it.
Let's trace that variance by diving into the top movers, because the data here just screams the two tapes thesis. Let's start with the foreign exchange market. The New Zealand dollar against the Japanese yen NZD JPY closed the month up a staggering 5.45%.
A massive move for FX.
Huge. The carry trade there was absolutely dominant. But conversely, the Canadian dollar against the Swiss franc CAD CHF dropped 4.55%. You have a commodity currency getting hammered against a traditional European haven.
Well, the foreign exchange market is actively pricing the brutal cost of holding divergent monetary policies right now. I mean, a carry trade mathematically relies on borrowing in a currency with the rock-bottom interest rate, like the yen, and using those funds to buy a currency with a high interest rate, like the New Zealand dollar.
You're just capturing that yield spread.
Right, capturing the spread. The New Zealand dollar thrived because we're in an environment where yield differentials are really the only game in town.
And the Canadian dollar.
The Canadian dollar suffered immensely because the underlying commodity tape, specifically crude oil, was getting violently whipsawed by geopolitical headlines in the Middle East. It's a pure expression of macro divergence.
That violent rotation, based purely on structural differentials, perfectly mirrors the identity crisis playing out in the digital asset space, too.
Oh, absolutely.
If you look at the cryptocurrency tape this month, it's like watching an entirely different asset class trying to figure out what it actually wants to be. At the absolute top of the board, you have TAO against the US dollar, up 138.4%. And IO against the US dollar, up 116.2%. This is pure, unadulterated, decentralized compute mania.
It is the digital reflection of the physical silicon supercycle.
Right.
TAO and IO represent decentralized networks that are attempting to pool GPU compute power for machine learning and AI tasks.
So Capital is aggressively front-running the idea that if physical compute is the bottleneck for the global economy, then the decentralized pooling of that compute commands an infinite premium.
That's the exact narrative. But if you scratch beneath that specific AI agent narrative, the rest of the crypto board is a bloodbath.
Yeah, real-world asset tokens and the alternative Layer 1 blockchains, the networks designed to compete directly with Ethereum, they were bleeding out.
Heavily.
Ondi was down 41.3%. WorldCoin dropped 36.2%.
And this is the defining mathematical signature of extreme dispersion. Total market cap didn't necessarily leave the cryptocurrency asset class. It just violently cannibalized itself.
Right, Capital abandoned the established smart contract platforms. Even legacy stalwarts like Ethereum and Solana experienced a terrible month relative to the compute narrative.
Because the aggregate market made a distinct structural decision. Intelligence is permanently bottlenecked on processing power. And everything else, decentralized finance, tokenized real estate, alternative consensus mechanisms, it's all just secondary noise that doesn't deserve a premium multiple.
Which brings us perfectly to international stocks, because that exact same thesis played out in the traditional equity markets.
It really did.
You have CREH Bros, ticker CBRS, up a massive 81.6% following its debut. Micron up 30.7%. And then on the losing side of the ledger, you have pharmaceutical giant Novo Nordisk dropping 22.7%.
Look, when you look at those equities, it confirms this is not random stochastic volatility. It's the two teeps thesis manifesting in raw executable numbers. Everything tied to the physical compute build-out flew off the charts. Conversely, everything tied to long-duration cash flows or shifting regulatory overhangs or legacy defensive narratives.
It just got severely punished.
Severely.
Let's transition into market sentiment, because reading the positioning data right now reveals a massive, dangerous divergence between institutional smart money and the retail crowd.
A very dangerous divergence.
Starting back on the foreign exchange tape with the Japanese yen, the textbook definition of the yen for the last 40 years is that it acts as the ultimate global safe haven.
Right.
When geopolitical panic hits or equities gap down, you buy the yen to hedge your portfolio. But the issue explicitly notes that this safe haven function is now officially broken.
It is entirely broken. The sovereign supply shock regime destroyed the yen's defensive utility. The yen now trades strictly and purely as a rate differential expression.
I mean, throughout May, the Bank of Japan delivered incredibly hawkish public commentary. They practically promised normalization.
They did.
Yeah.
But they didn't actually execute a rate hike.
Right.
And the market, which operates as this incredibly unforgiving discounting mechanism, it heard the aggressive rhetoric, recognized the complete lack of physical action, and traded the inaction.
They called the bluff.
They absolutely called the bluff. Leveraged short yen positioning rebuilt aggressively into the end of the month. Algorithms pushed USD yen near the 159 level.
So if your risk model still assumes the yen will automatically catch a bid when the S&P 500 drops 2%, your hedge is fundamentally defective. It's not a risk hedge anymore. It's just a cold math equation on the yield gap between Tokyo and Washington.
Exactly. And speaking of Washington, the US dollar is facing a severe crisis of identity of its own. The magazine describes the dollar's current positioning as a layer cake problem.
The layer cake.
Because traditional textbook logic dictates that if the 30-year bond route pushes long-term U.S. yields above 5%, the dollar should soar.
Right.
Because global capital will flood into the U.S. to capture that massive risk-free return.
Right. Capital flows to where it's treated best. But looking at the charts, the dollar was actually soft against the broader G10 currency bloc for much of the month, which contradicts the textbook. I want to unpack this layer cake metaphor. What are the actual layers driving this anomaly?
Okay, let's break down the layers. The bottom layer of the cake is the yield advantage. That is the engine attempting to drive the dollar higher. But the middle layer is the structural debt burden. And the top icing is geopolitical fiscal credibility.
So the weak auctions hurt the credibility.
Exactly. The same weak Treasury auctions that lifted those yields simultaneously signaled to the world that the U.S. has a massive, perhaps unmanageable, term premium and fiscal credibility problem.
Wow.
So the structural takeaway for systemic algorithmic books is that the dollar's directional path is no longer driven by the rate differential gradient alone. It's locked in a brutal daily competition. The high yield supports the currency, but the deteriorating fiscal credibility actively undermines it.
So the yield acts as the engine, but the loss of fiscal credibility is like a massive anchor dragging behind the boat, creating immense drag.
That's a great way to put it.
Now, if we move the sentiment lens over to the stock market, the retail crowd definitely chased the Silicon tape. But here is where the sentiment readings get incredibly dangerous.
Yeah, this was wild.
The issue highlights a tiny, obscure European chip manufacturer that spiked massively intraday. And the catalyst wasn't earnings. It wasn't a new product launch. It spiked purely on a viral social media post.
Zero fundamental news.
Zero. It just flew, triggered volatility halts, and then gave the entire move back almost as fast.
Well, for a quantitative analyst, that specific event is the textbook signature of a crowded, reflexive late-cycle phase. When price action detaches entirely from fundamental catalysts and begins feeding purely on its own attention metrics, it tells you that the positioning in the broader sector is heavily, dangerously one-sided.
The marginal buyer has become completely price insensitive,
Completely.
which means your algorithm should treat this as a flashing red warning light, not a breakout signal.
Exactly. It's a risk gauge. It tells you that the retail crowd is aggressively reaching for the obvious mega-cap AI names. But when those mega caps become too expensive to trade on margin, retail frantically searches for obscure, low-float adjacent names to bid up.
They're just chasing the aura of the sector.
Right. And the danger for momentum algorithms is the unwind. Because when the narrative breaks, those obscure names gap straight down through every resting stop-loss order on the book. Because there's absolutely no fundamental valuation floor beneath them to catch the falling knife.
So if your execution logic is just, surfing the momentum wave without measuring the underlying fundamental anchor like the order book depth, the institutional participation, you are going to suffer catastrophic drawdown when the music stops.
You'll get wiped out.
This really highlights the necessity of a tool like the Beaux-Arts scanner. You need multiple uncorrelated analyzers confirming the structural health of a breakout. You can't rely on a social media velocity metric.
Precisely. You must verify the liquidity pockets. You have to measure the actual institutional order flow. Because the macro drivers fueling these two divergent tapes are immense, and they will crush poorly sized retail positions without hesitation.
Let's dissect those massive macro drivers. Because the major financial and geopolitical events of May 2026 really rewrote the baseline assumptions for the rest of the year. Let's start with the cover story. The Silicon Supercycle and the CREH Bros' initial public offering.
The big one.
Yeah. They priced their shares at $185. It opened for trading somewhere between $350 and $385. Intraday, the valuation touched $100 billion. By the closing bell, the stock had settled up roughly 68% from its offering price.
It's a deafening roar from a technology issuer. We haven't seen anything like it in years.
But a quant desk has to look past the media excitement, right?
They have to. The temptation is to categorize this simply as equities being aggressively bullish and move on to the next ticker. But that ignores the structural signal. The CREH Brothers debut did something far more important than generate a single-day return. It reopened a primary market window that had been effectively slammed shut for technology issuers since the aggressive central bank rate hikes began back in 2022.
So explain the transmission mechanism there. Why does one successful IPO alter the landscape for companies that aren't even public yet?
Well, when an AI infrastructure listing is that successful, and the institutional order book is that heavily oversubscribed, it instantly changes the calculus for every single late-stage private company sitting behind it in the pipeline.
Like the private model training labs, the data center operators.
Exactly. The cooling infrastructure companies. A successful public debut establishes a credible liquid exit at a premium multiple.
So it solves the liquidity trap for venture capital.
Precisely. When the exit window reopens, late-stage private valuations immediately remark upward. Venture capital and growth equity funds can finally crystallize their paper returns, take that actual liquidity, and aggressively redeploy it into the next generation of startups.
Wow.
So the ultimate macroeconomic transmission channel here is that the global cost of capital for the entire artificial intelligence build-out just experienced a massive structural decline.
And this is exactly where the control room analogy hits its breaking point. This is where the two tapes violently collide. Because on the exact same timeline where the cost of capital is falling for AI infrastructure, the macroeconomic tape is screaming that the global price of money is rising rapidly.
It's the global long bond route.
Yeah. On May 13th, the United States Treasury went to market to sell $25 billion of 30-year bonds, and the high yield cleared at 5.046%.
That is a critical threshold. It is the first time the 30-year auction has cleared above 5% since August 2007, just before the global financial crisis.
But the absolute yield is only half the story, right? The internals of the option were incredibly weak.
Very weak. The bid-to-cover ratio came in at a soft 2.3, and the option priced with a tail.
Okay, for the modelers who might track equity order books but don't spend their days deep in sovereign bond microstructure, what do those two metrics, the bid-to-cover ratio and the tail, actually tell us about market health?
So the bid-to-cover ratio measures the total value of bids received from the market, divided by the total value of securities the government is offering. A ratio of 2.30 is weak by historical standards.
It signals a lack of demand.
Right. It signals that the primary dealers and the massive end investors, the sovereign wealth funds, the foreign central banks, the pension funds, they were not aggressively competing to buy the debt. And the tail means that the highest yield the Treasury was forced to accept to clear the auction was actually higher than the yield that was trading in the pre-auction when issued market.
So they had to sweeten the deal just to get it sold.
Exactly. It's a definitive measurement of demand exhaustion. It indicates that the traditional buyer base is thinning out, likely as foreign holders diversify away from U.S. debt. And the remaining buyers are demanding a massive premium before they're willing to absorb one more dollar of supply.
And what makes this so dangerous is that it wasn't an isolated, idiosyncratic U.S. event. It was a synchronized global repricing of sovereign risk. I mean, UK 30-year yields hit their highest level since 1998. Japanese 30-year yields touched record levels.
The primary driver was a shared global term premium shock rather than some domestic narrative. And the most chilling confirmation of how serious this sovereign stress has become arrived on May 18th when the G7 finance ministers convened in Paris.
Oh, right.
The bond market had spent the entire preceding week aggressively testing how far the long end of the yield curve could run. Institutional desks were looking closely to the G7 for a signal. They were anticipating a coordinated backstop, perhaps a joint intervention statement to cap yields.
You'd expect something like a Plaza Accord 2.0 to stabilize the debt markets, but looking at the official communiques from the summit, they essentially threw their hands up.
Complete silence.
They offered absolute silence on a solution.
No coordinated backstop emerged. The European Central Bank president essentially acknowledged the mathematical worry, but offered absolutely no mechanism to cap the rising yields. And if you map the policy constraints, the reason for their silence is simple. There is no clean policy lever left to pull.
Because if they cut short-term rates to ease the funding stress, they just feed the inflation pipeline, which drives long-end yields even higher.
Exactly. But if they hold rates high to fight inflation, the compounding arithmetic on sovereign debt service deteriorates to the point of insolvency. By choosing to merely describe the problem rather than solve it, the G7 signaled to the quantitative models that the divergence between the inflation fight and the debt burden will just be allowed to run its course. Long yields are essentially unchecked by policy.
Which brings us to the RBA. Because if you want to examine central banks trapped in inflation fights, the Reserve Bank of Australia delivered a massive localized shock to their system. On May 5, they hiked their cash rate by 25 basis points to 4.35%.
A huge move.
This marks their third consecutive hike of 2026, which completely aggressively reverses all the rate cuts they delivered back in 2025.
And the Australian macro structure is incredibly instructive for the rest of the developed world because their economy is uniquely heavily leveraged to domestic housing. And crucially, unlike the United States where 30-year fixed mortgages dominate, a massive share of Australian mortgages are priced on variable floating rates.
So the transmission mechanism is instantaneous. When the RBA hikes, that cash rate move bleeds directly into household budgets within weeks, draining consumer liquidity immediately rather than taking years to roll over.
Exactly. They're tightening policy directly into an inflation impulse, which is largely an imported energy shock, using a blunt tool that bites their own domestic demand the hardest.
Ouch.
Yeah. For systematic books worldwide, this action confirmed that the higher-for-longer regime is not just a U.S. idiosyncrasy driven by American fiscal spending. It is a synchronized, unavoidable developed market reality.
We also have to address a major geopolitical event that carried immense market implications: the May 13 Beijing summit between Trump and a delegation of Wall Street and tech CEOs. Now, I want to be extremely clear here for the listeners. We are examining this purely through a quantitative mathematical lens. We are strictly ignoring all political commentary or ideological viewpoints.
Right, just the data.
Just the data. Strictly looking at the data, the summit resulted in a highly specific, tradable reversal of an export restriction that had previously capped a major revenue line for a leading AI chip company. So, how does a systematic desk properly price an event like this?
From a strict quantitative perspective, this is categorized as a discrete, headline-driven risk factor. It is a binary input. It's not a smooth gradient or a slow-moving macroeconomic trend.
It's just a switch flipping.
Right. When an export control loosening adds a massive revenue line that valuation models had previously written down to zero, the upside repricing on that specific asset is large, immediate, and violent. However, because that exact same revenue line can be withdrawn by a single executive action just as quickly, it mathematically caps how much of the gain the market will durably capitalize into the share price.
So the asset gaps up on the initial clearance headline, but then it trades sideways with a permanent structural discount attached to it.
Correct. The concession is entirely reversible. Therefore, that permanent discount is the option premium the market charges to hold the political risk. The model prices the probability of a sudden reversal directly into the baseline valuation.
That makes perfect mechanical sense. You can never value that revenue stream at a 1-to-1 ratio with domestic revenue. Okay, let's shift from the broad macroeconomic events into the most impactful, highly localized news stories that created severe market whipsaws in May. Starting with the geopolitics, the Iran war whipsaw was brutal for energy traders.
Oh, the crude oil tape this month was completely held captive to a relentless posting cadence of strike and ceasefire headlines.
Just back and forth.
Back and forth.
Yeah.
The market swung faster than any execution model keyed to a traditional scheduled policy calendar could possibly follow. It serves as a clear, definitive example of why automated headline ingestion, where natural language processing algorithms detach directional inference directly to execution rails, is no longer an experimental alpha generator.
It's basic table stakes for any serious desk.
Exactly. Because if your fundamental model is sitting there patiently waiting for the weekly EIA inventory report on Wednesday morning, while the high-frequency headline algorithms are trading a ceasefire announcement in milliseconds on a Sunday night, your desk is just going to bleed capital.
You're bringing a knife to a gunfight.
You are. And the defensive corollary here is strict position sizing. When the gap risk widens on every single headline-driven session, your position sizing architecture must mathematically assume the risk of a worst-case overnight headline. You have to size down because the move will hit the tape and reprice the asset long before a human risk manager can spill their coffee and react to it.
Let's transition from energy whipsaws to a massive structural shift in the pharmaceutical sector. We need to look at the Novo versus Lilly oral GLP-1 obesity war. Novo Nordisk slid quite significantly this month.
Yes, the fundamental battleground in the obesity market moved permanently from the injectable syringe to the oral pill.
The daily pill.
Right.
Yeah.
The American pharmaceutical giant successfully cleared an oral GLP-1 compound for weight loss, and they spent the entire month aggressively ramping up their launch against the Danish incumbent's oral version of its own blockbuster drug.
And this completely rewrites the sector's valuation. It turns a massive duopoly built on once-weekly refrigerated injections into a highly aggressive race for the significantly larger total addressable market that a daily ambient temperature tablet unlocks.
And the key differentiator here isn't necessarily a massive leap in clinical efficacy, right? It's the logistics. Convenience is the absolute moat.
Convenience is the entire value proposition. I mean, a pill that doesn't require cold chain refrigeration logistics and doesn't involve the psychological barrier of needles massively expands the addressable patient population.
Instantly reprice the entire obesity complex.
Yeah.
The structural read-through for quantitative models is that this channel is now driven entirely by free market competition, not regulatory policy. You saw smaller clinical stage developers with credible oral candidates rally aggressively on positive trial feedback. Simultaneously, the legacy cardiometabolic names, the medical device makers heavily exposed to bariatric surgery volumes, and even the consumer food demand proxies started slowly, structurally reshaping their forward multiples.
That dynamic of competition reshaping an industry natively is fascinating. But over in the broader healthcare policy space, we saw the exact opposite this month. We saw the government actively stepping in to permanently alter the margin math. On May 18th, the United States Supreme Court SCOTUS declined to hear the pharmaceutical industry's challenge to the Medicare drug price negotiation program. This refusal left the lower court rulings entirely in place.
And this event is exactly why isolating factors in your models is so crucial. The named challengers, which span the largest American and European pharmaceutical houses, had argued that the negotiation program amounted to an unconstitutional taking of private property.
But the court said no.
By refusing to grant certiorari and take the case, the Supreme Court effectively ends the legal escape route and makes this pricing regime permanent. The transmission channel here is constitutional law feeding directly into operating margins. A manufacturer that refuses to negotiate with Medicare faces a punitive compounding excise tax, meaning the mandated discounts are not actually optional.
So the negotiated price haircut transitions from a contingent legal risk that, say, a DCF model might assign a 50% probability to, into a durable, non-cyclical, 100% certain headwind.
Precisely. For a quant, this represents a permanent compression of the discount rate applied to the protected cash flows of those specifically named drug makers. It is a durable repricing. Broad, cross-sector models simply do not encode this properly unless you manually separate the litigation factor from the fundamental operations. You have to treat the legal calendar for those specific pharmaceutical names with the exact same scheduled volatility expectations as you would a quarterly earnings date.
That is a phenomenal, actionable insight. When government policy permanently caps corporate margins, the models have to adapt instantly. But what happens when the massive margin squeeze comes from Mother Nature instead of a courtroom?
The cocoa squeeze.
Let's look at the incredible ICE cocoa squeeze. July cocoa jumped as much as 9.83% in a single session, peaking near $4,709 a ton before falling all the way back toward the $3,800 level. What actually happened here mechanically on the exchange floor?
This was the month's cleanest, most violent lesson in positioning completely overriding fundamentals. Hedge funds and speculators had built a massive, historically large net short position of nearly 19,885 contracts. The dry tinder for a massive short squeeze was entirely laid out.
They just needed a spark.
All it needed was a spark. That spark arrived in the form of weather. Severe, unseasonal heavy flooding in Ivory Coast, which is the dominant global producer. That highly credible weather threat to the physical harvest met the incredibly crowded short positioning, forcing massive margin calls and panicked covering into a very thin market.
So the resulting price move massively overshot the physical supply fundamentals.
Exactly, because algorithms were just buying at market to close their short exposure, regardless of the price. But then gravity and the fundamentals reasserted themselves.
Right. A few days later, Ivory Coast officially raised its 2025-2026 delivery estimate, confirming that despite the rain, there was a projected physical surplus. And the price immediately gave back most of the spike.
The systemic takeaway is that extreme fund positioning heading into a seasonal weather window will inevitably squeeze. But your execution logic should trade it to fade the spike once the physical supply data confirms the surplus. To put it simply, you never stand in front of a record short position when the rain arrives.
Never stand in front of a record short when the rain arrives. That needs to be framed on the wall of every commodities desk. Let's touch on one more distinct commodity shock. The Shaanxi fatal coal mine disaster on May 27.
Yeah, a tragic fatal gas blast triggered a massive emergency safety response across the entire Chinese province. Regional authorities ordered immediate inspections and sweeping operational shutdowns.
Which instantly idled a highly meaningful slice of regional coking coal capacity.
Right. It served as an instant physical supply shock to the global steelmaking chain. The futures market on the Dalian Commodity Exchange reacted violently, moving limit up and rising over 8.9% in a single session.
And this creates a really interesting divergence for pair traders, right? Coking coal spikes limit up, but the price of iron ore actually softens. Explain the chemistry and the economics driving that divergence.
It comes down to the mechanics of the blast furnace. Coking coal and iron ore are both essential inputs for steelmaking, but the two legs of the input complex moved in opposite directions based on a single safety order.
Because if steel mills face forced curtailment because they can't source coking coal, their blast furnaces go idle.
Exactly. And if the furnaces are idle, their concurrent demand for iron ore instantly plummets. Therefore, for a systematic desk, the optimal trade structure is a coking coal long against an iron ore short pair trade, held strictly into the shutdown window and sized very precisely for the reversal risk of the moment the safety inspections conclude and the mines reopen.
Okay, let's pull the lens back and tie all these fragmented, localized stories into the actual macroeconomic calendar and the mechanics of the broader market movements. We had some massive dates scheduled in May.
Very heavy calendar.
U.S. Consumer Price Index printed on May 12, hitting a three-year high entirely driven by energy pass-through costs. U.S. Producer Price Index printed on May 15 at 6% year-on-year, the hottest factory gate inflation since January 2023. The FOMC minutes dropped on May 20, revealing 4 distinct dissents anticipating further rate hikes.
4 dissents, that's significant.
And then on May 22, Kevin Warsh was sworn in as the new Fed chair in the closest modern confirmation vote in history.
That calendar paints a very clear picture of unrelenting, compounding pressure on the macro tape. You have inflation distinctly re-accelerating through the energy and goods pipeline, which fed directly into those hawkish FOMC dissents. The transition to Warsh as Fed chair without any rate cuts priced into the forward curve just compounded the institutional uncertainty. Markets had to aggressively trade the arrival of an unproven chair who was actively leaning into a hawkish, fractured committee.
But right in the middle of all that intense macro pressure, Tape 2 the bullet train just does its thing. Let's look at the mechanics behind Micron crossing the $1 trillion market capitalization mark.
A huge milestone.
The stock was up roughly 19% in a single session on May 26. How does an enterprise of that sheer size move 19% in a single day without a buyout offer?
It was a fundamental mathematical repricing of the asset's core identity. The market aggressively repriced memory chips from a boom-bust cyclical commodity toward contracted infrastructure.
Contracted infrastructure.
Yeah. Micron has their production capacity entirely sold out deep into 2026 on long-dated agreements at partially fixed pricing. That high bandwidth memory thesis completely changes the valuation multiple the market is willing to assign. When a memory manufacturer behaves less like a commodity cyclical and more like a utility annuity with a multi-year guaranteed order book, it carries a structurally higher, much more stable valuation.
So it wasn't just a wave of retail meme stock hype, it was a rigorous mathematical re-rating by institutional models.
Exactly. A sharp upgrade cycle from Tier 1 banks lifted price targets across the entire memory complex, violently pulling forward the institutional bid. And the broader silicon tape momentum fueled heavily by the Say REH's debut reopening the IPO window created a massive thematic vacuum that capital just rushed to fill.
It systematically lifted semiconductor EPFs, and major Korean peers passed their own trillion-dollar marks in that exact same trading window.
It was a rising tide for silicon.
And we also saw leverage positioning mechanics driving USD yen near 159, which we touched on during the sentiment read. For a quant, it is the highest conviction expression in the FX market, but simultaneously the most fragile because the core position and its catastrophic tail risk are the exact same trade.
That is the paradox of the carry trade. It is built entirely on a rate differential expression.
Yeah.
It prints money every single day, and the algorithms assume it's correct right up until the exact millisecond the Bank of Japan actually intervenes in the currency markets.
And then it triggers margin calls and becomes the fastest, most violent unwind on the board.
Precisely.
Okay, so we've mapped the two tapes. We've seen the high-speed bullet train of the silicon supercycle pulling everything up and the buckling freight train of the bond route dragging everything down. What is the outlook? What are the absolute key takeaways for systematic traders as we build our models for the June 2026 catalysts?
The primary overriding risk heading into June is convergence. Convergence. Right now, the two tapes are completely decoupled. That decoupling is highly seductive for portfolio managers because it makes a long silicon book look perfectly diversified against macro risk when mathematically it actually isn't. The rising cost of money on the macro tape will eventually, inevitably, reach across the aisle and reprice the valuation abundance on the silicon tape. A correlation that feels comfortably low right now will violently snap toward one exactly when a hedge would be most useful.
So you can't just program your algorithms to assume AI infrastructure stocks will ignore 5% treasury yields forever.
Absolutely not, because the mathematical channel that breaks the silicon tape is the discount rate applied to future cash flows, not the index correlation. Practically, that means you have to stress test your long silicon equity book against a sudden rate shock rather than a traditional equity beta shock.
So April was the regime test, May was the regime operating under heavy load, and June is where the load meets the fault line.
That is the exact sequence. And the mechanical threshold that matters most for systematic books right now is the yield curve steepener. Short-term rates are firmly anchored by central banks that have completely stopped cutting, while long-term rates are aggressively rising on inflation persistence and sovereign supply.
What are the levels to watch?
The operative thresholds you must watch are a 10-year Treasury yield sustained above 4.65% and a 30-year yield holding above 5.25%. Those are the absolute mathematical levels at which long-duration equity multiples will violently, indiscriminately re-rate downward.
This brings us perfectly to the community corner, because navigating a fault line like that requires incredible operational discipline. This month, the issue highlights something truly fascinating occurring within the ecosystem: the hedge fund experiment.
Yes, this was a great read.
This is a scenario where a group of individual traders within the ASWAC 4U community actually organize themselves to operate with the rigor of an institutional desk.
It's a brilliant structural evolution of the retail trader. They formally governed and documented their analytical processes, deliberately valuing mechanical discipline above the daily profit and loss scoreboard. And the analytical workflow they built is incredibly robust. They utilize InnoRadar to read the primary asset scanning. Throughout May, the radar showed a geopolitically driven risk-on rally across broad equities that the smart money positioning didn't actually believe or participate in.
And they confirmed that institutional skepticism using MPA, the macro prompt assistant, right? How exactly did they utilize the assistant to validate the warning?
MPA supplied the underlying structural warning beneath the superficial rally. It synthesized a powerful, glaring divergence between institutional positioning, which it read directly through the historical commitment of traders' reports, and the temporary relief bounce in the spot market.
What did it find?
The assistant revealed that smart money was decisively bearish across nearly the entire foreign exchange board, while retail capital sat heavily, crowded short on the Antipodians, universally bullish on the Middle East ceasefire and Hormuz reopening hopes.
Sure.
By analyzing the structural divergences, the clearest high-conviction signal the assistant derived was to go long gold.
And then they layer in IFFA, the institutional flow tool, to track where the big money is actually migrating. The tool read a decisive risk-on rotation into cyclicals and aggressively out of defensives. The Bank of America May Fund Manager Survey showed a record net 50% overweight in equities. Technology was up 33%, financials up 30%. Meanwhile, defensive utilities were sitting at a massive net negative 39% underweight.
The institutional capital is aggressively paying up for the AI infrastructure build-out and simultaneously dumping the bond proxies. So the collective, synthesized prediction the community arrived at was split by time horizon. In the short term, the tools unanimously agree that the risk-on tape and the AI leadership carry the momentum. But longer term, the commitment of traders' divergence and the faded war premium strongly argue the bounce is borrowed time. Gold emerged as the one single trade where the three distinct dashboards did not disagree.
And the way they execute this analysis is what really stands out to me. It's a rigid, mechanical pipeline. They don't just click buy. They scan for confluence using the 23 distinct analyzers in the Beaux-Arts scanner.
Right.
Once the multi-analyzer alignment is perfectly clean, they drop into the deep dive card to manually verify structural health and locate resting liquidity pockets. If there's a thin confirmation or low volume, they discard the idea immediately. Then they use the InnoTrend Global Verification Matrix as a top-down trend filter, strictly waiting for the daily and weekly sells to agree.
It's extremely disciplined.
Then they prove the idea on the historical record using the InnoTrader Lab backtests. Finally, and only finally, they let the InnoTrader System expert advisor execute the trade at the exact test-justified risk parameter. No single trade is ever taken on a hunch. It is a disciplined mathematical pipeline.
It systematically removes the human emotional discretion that usually leaks alpha. A rule is mechanical. You never take a 1-minute buy badge against a daily sell trend. You only risk actual capital on a quantitative idea that survives the rigorous historical record.
Which is exactly the cold, calculating mindset you need to tackle the biggest, most emotionally charged question in the market right now. In our headline segment in A Detective, we're diving deep into the truth behind the AI bubble.
$1 million question.
This is the question every quant, every portfolio manager, and every retail trader is asking themselves at night. Are we just reliving the year 2000? Are we in the dot-com repeat, waiting for the floor to fall out?
The magazine asked that question strictly as quants, stripping out all the media narratives. We looked across deeply measurable markers to see if the current AI supercycle genuinely resembles the 2000 dot-com peak. And the mathematical verdict is that it only rhymes on two very specific markers.
Just two.
Just two. First, the restrictive rate backdrop. Both eras face rising costs of capital from the central bank. Second, the index concentration. The top 5 names driving the S&P 500 right now command a concentration that is actually worse today than it was at the absolute peak in March 2000. But that is exactly where the historical similarities end.
Right, because when you look at the other fundamental markers, the current tape diverges sharply from the year 2000.
Exactly. It diverges massively on forward valuation multiples. It diverges on internal sector dispersion. It diverges on IPO froth, where companies with no revenue went public weekly in 2000. And crucially, it diverges on actual profitability.
They're actually making money.
The wafer-scale semiconductor leaders and the memory fabricators driving this tape are not cash-burning ideas with a .com tacked onto their corporate name. They are phenomenally historically profitable enterprises. They possess contracted, inelastic demand and multi-year guaranteed order books.
So the danger here isn't buying a profitless Pets.com that will go bankrupt in 6 months. The true danger is buying a very real, highly profitable company at a terminal multiple that mathematically assumes infinite growth.
That is precisely the danger. The danger is absolutely real, but it is structural, not existential. If a single large hyperscaler like Microsoft or Google trims a quarterly capital expenditure plan, or if a cheaper, highly optimized model architecture suddenly lowers the compute intensity required for AI inference, the entire inelastic supply story violently inverts.
Because the physical data center capacity that took years to build arrives on the market exactly as forward demand softens.
And these mega-cap names will derate as traditional cyclicals with very painful gap-down speed. But we must give the honest, rigorous quant caveat here. We are merely measuring resemblance, not statistical probability. This is a sample of one. We do not have a robust statistical history of multiple AI supercycles to backtest our models against.
That is the ultimate sobering reality check for any model builder. You can measure the current structure down to the tick, but you cannot statistically predict the exact moment the capital expenditure music stops. Finally, let's take a brief look at the bleeding edge of quant technology this month in the Technology and Tools segment. CME Group launched new compute futures. This is wild. They're literally treating silicon-dated GPU compute time as a financialized, tradable commodity. How does that even work mechanically?
It makes perfect macroeconomic sense. If GPU compute is the binding constraint on the entire modern economy, it will inevitably be financialized. Mechanically, they are creating a standardized index of compute cost, allowing data center operators to hedge their forward infrastructure investments and allowing speculators to bet on the spot price of processing power just like they would barrel of crude oil.
Fascinating.
We're also seeing intense regulatory scrutiny on prediction market flow, highlighted by the Google Polymarket Alpha Coon insider trading case.
That case unsealed a really uncomfortable reality for alternative data platforms. On-chain transparency makes the data incredibly tradable, but it is the exact same immutable property that makes it permanently surveillable by regulators.
Exactly. Every quantitative desk that was reading decentralized prediction market flow to gauge retail sentiment has been abruptly forced to re-examine the legal integrity and the alpha decay of that signal.
And the May issue also highlights 3 incredible, highly technical quant research papers that modelers need to read. First, we have the decision time leakage benchmark. This is critical for anyone running automated backtests. It proves how look-ahead bias creeps into your historical returns when your data timestamps don't account for network latency or exchange processing times.
You think your algorithm is brilliant, but it's just peeking into the future.
Exactly. Then there's the KTDFin LLM agent benchmark, testing knowledge-injected, memory-controlled large language models specifically in trading environments to prevent them from hallucinating false earnings data. And finally, the SIDEX series framework. This is a model-free approach for density extraction and short-dated options. It essentially allows quants to move away from the rigid arbitrage and log-normal distribution assumptions of traditional Black-Scholes pricing. The sheer depth of the research in this issue is staggering.
It is the rigorous machinery required to survive a market that is permanently split into 2 tapes. You simply cannot navigate a structural macroeconomic decoupling with rudimentary outdated tools.
So, to bring it all back to where we started in that control room, we have the frictionless bullet train of silicon and the buckling freight train of the global bond market. I want to leave you with a provocative thought that builds on everything your models will have to digest from today's deep dive. If the AI supercycle is genuinely physically bottlenecked by power generation and data center cooling, what happens to the silicon tape when the traditional energy markets experience their next true geopolitical supply shock? If the power grid itself becomes the ultimate scarce commodity, does the tech melt-up suddenly find itself completely at the mercy of the macro tape it has been so aggressively ignoring? That is something to mull over as you map your own exposures and stress test your portfolios for June.
A great thought to end on.
Download our magazine, this issue and every past issue, for free at aswacmag.com. The magazine is available in 3 languages, English, French, and Arabic, and it's released monthly. A monthly podcast like this one discussing each issue is published on our YouTube channel. If you're passionate about finance, follow our TikTok channel, eNiTrader Hub. And if you're looking for a professional-grade community of traders to exchange ideas with and to learn trading through a scientific, data-driven approach, not dreams and imagination, visit our website, eNiTrader.com, to learn more about us and how to join our community.